Imagine you're 20 miles into a marathon. Your body is screaming, your glycogen stores are just completely depleted, but you are still somehow keeping a competitive pace.
I'm with you. It hurts just thinking about it.
Right. Then, without stopping, while your feet are still pounding the pavement, you decide to perform a heart transplant on yourself.
Okay, that's quite an image.
You decide to rip out the cardiovascular system that got you all the way to mile 20, let's call it the Bitcoin engine.
Yeah.
And you decide to replace it with a nuclear reactor. Let's call that the AI high-performance computing engine.
A nuclear reactor. I like that.
Now, imagine stumbling a bit while you're swapping out these vital organs mid-stride, and then having to explain to a crowd of screaming spectators why your pace dropped for a few minutes.
That, in a very messy nutshell, is the situation IREN Limited is in right now.
It is. It's a visceral image, but honestly, it's not hyperbole.
Not at all. We are watching a company attempt a fundamental metamorphosis in real time, right under the microscope of the public markets. It's like high-wire corporate surgery without a net.
Exactly. We are talking about IREN, which you might remember as Iris Energy. And today we are unpacking their fiscal second quarter of 2026, which just dropped. We have a dense institutional-grade analysis in front of us, and let me tell you, it is a roller coaster of accounting noise, strategic pivots, and market punishment.
It really is. And our mission today is to figure out, is this company actually crashing, or is this just the unavoidable, incredible mess of a construction site?
Is it a demolition or a renovation?
That's the question. This is the textbook definition of the Valley of Transition, that dangerous cash-burning middle ground where the legacy business is fading out, but the new business hasn't quite taken the weight yet.
Before we dive in, this analysis is brought to you by STOCKANALYTIcs.AI. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at STOCKANALYTICS.AI. Now, let's get into it.
All right, so let's set the scene. We are looking at the earnings analysis for the quarter that ended December 31st, 2025. The numbers were released on February 5, 2026.
And the market reaction was, let's just say it was brutal, but interestingly, not fatal. There's a lot of nuance here. We need to go through this systematically because the headline numbers are frankly terrifying if you don't know what you're looking at.
They really are. You see the headlines and you just assume the worst.
So let's pull up the first section to get into it.
The at-a-glance scorecard.
Okay, I'm looking at the source material here. And there is one word stamped across the top in big, bold red letters, MICAIME-SS. And it's not a small miss.
No, it's emphatic. It's in all caps. And in this environment, with the AI trade being as crowded as it is, a miss isn't just an accounting error.
It's more than that.
It's viewed as a violation of trust. It means the company failed to execute on the trajectory, on the story they sold to Wall Street just 3 months ago.
So let's break down the magnitude of this because it's pretty staggering. Yeah. Reported revenue came in at what, $184.7 million?
$184.7 million, right?
Now, for context, just 90 days ago in Q1, they pulled in $240.3 million.
A huge difference.
That is a sequential decline of roughly 23.1%. I mean, a quarter of their revenue poof. It evaporated in 3 months.
And that's the sequential drop, which is bad enough on its own. But the real pain, the reason the stock took such a beating, is the gap between that reality and the expectation.
The Wall Street number.
Exactly. The analysts who supposedly model every megawatt of this company's capacity, they were expecting revenue between, say, $229 million and $230 million.
So they basically expected performance to be flat.
Pretty much. They thought the Bitcoin decline would be offset by the AI ramp. Instead, IREN came in about $45 million light. That is a 20% top-line miss.
Okay, stop there for a second. A 20% miss on revenue. I mean, I see companies get punished for a 2% miss. A 20% miss suggests the models that everyone on the street were using were fundamentally broken.
Completely broken.
How does a company with, theoretically fixed assets and predictable power contracts miss by that much? It doesn't seem possible.
It's a great question, and it's the right one to ask.
Right.
When you miss by 20%, it signals one of two pretty stark things.
Okay.
Either the legacy business, the Bitcoin mining side, collapsed unexpectedly. Maybe there was a massive spike in network difficulty or extended downtime at their sites in British Columbia. Something went very wrong there.
Oh.
Or, and this is the more concerning angle if you're a bull on the company, the AI ramp-up was significantly slower than they projected.
So construction delays.
Right.
racking the servers, getting them online, that kind of thing.
Exactly. If you're an analyst and you modeled that 1,000 NVIDIA H100s would be online and generating revenue in November, but they didn't actually get switched on until January, well, you have a massive revenue hole in your spreadsheet.
In the data center game, time is literally money. Every hour a GPU is sitting idle is
If
just,
lost revenue, you never get back.
you never get it back. And if that revenue miss wasn't enough to induce panic, let's look at the bottom line. Net income, or rather the lack thereof.
Yeah, this is the number that really jumps off the page.
This is the number that makes the algorithm sell instantly without asking questions. Reported net loss of negative $155.4 million.
Okay, we need to pause on this. Because in Q1, just the prior quarter, they posted a net income of positive $384.6 million.
A massive profit.
We are talking about a swing of over $500 million, $540 million to be precise, in 90 days. How does a company go from massive profitability to a massive loss that quickly? I mean, did they lose the keys to the bank vault?
It seems like it, but no, and this is where we have to start peeling the onion and separate the cash from the, let's call it accounting fiction.
Okay.
A huge portion of that swing is non-cash, which we will detail in a minute on the next slide. But headline traders and the algorithms, they don't look at the footnotes immediately. No, they look at the EPS, the earnings per share.
Which was also a disaster, a reported loss of negative 52 cents per share.
52 cents. And the expectation was...
Against an expectation of a loss of maybe 7 to 9 cents.
Wow.
So they missed the bottom line estimate by about 45 cents per share. I mean, that's not a miss. That's a completely different universe of performance. A massive deviation.
I see a note here in the analysis, something about an anti-dilutive effect. It sounds like complex legal jargon. What does it mean for the person at home, holding the bag?
It's a GAAP accounting quirk, but it's important. Usually when we talk about EPS, we look at diluted EPS. That number accounts for all the potential shares that could be created from stock options, convertible debt, things like that.
Right, it assumes the pie is cut into more slices.
Exactly. And it usually makes the earnings look a little bit smaller per share, which is the conservative way to do it. But the rules say that if a company is losing money, you can't include those extra shares in the calculation. Because adding more shares would dilute the loss per share. It would make the loss look smaller per person. And you're not allowed to make a loss look better than it actually is.
So they can't spread the pain out over theoretical shares. They have to take the full hit on the actual shares that are outstanding right now.
Correct. It makes the per share loss look deeper, which is what we see here. It's an accounting rule designed for accuracy, but it just makes a bad headline number look even worse.
So let's recap. We have a 20% revenue miss, a massive earnings miss, a $500 million negative swing in profitability. The stock dropped, 11.5% in after-hours trading? Honestly, looking at this scorecard, I'm surprised it didn't drop 30 or 40%. What held it up?
And that's the key question, isn't it? If this company was just a plain vanilla Bitcoin miner that missed numbers this badly, it would be down 30%, no question.
Absolutely.
But the cautious optimism that's mentioned in the source material, it all comes from the AI narrative. Specifically, investors are looking past this messy quarter at things like the Microsoft deal that was announced previously.
Right, the deal to use IREN's GPUs for AI workloads, a huge validation.
A huge validation, exactly. That deal is the anchor. It tells the market, hey, we might be bad at managing construction timelines, and our accounting is a total mess right now, but a company like Microsoft trusts our infrastructure.
So that provides a floor to the stock price. The market is betting that the execution issues are temporary, but the demand from blue-chip customers is real and permanent.
That's the thesis in a nutshell. The renovation is a disaster, there's dust everywhere, and we're way over budget, but we have a signed lease with a billionaire tenant for when it's finally done.
That is precisely the bet. But now we have to figure out where all that money went. Because a $155 million loss is still a $155 million loss. It's hard to stomach, no matter how you frame it.
Right. We need to go find that $500 million swing.
Let's open the hood and look at the mechanics.
The engine of profitability.
We're calling this section the mystery of the decoupling. And here's why. Revenue dropped 23%. Okay, that's bad, but it's manageable. Net income, however, collapsed over 140%.
It went from positive $384 million to negative $155 million.
Right. And that just doesn't make sense mathematically in a normal operating business. If I sell 20% fewer widgets, my profit usually drops 20% or, maybe 30% due to operating leverage. Doesn't fall off a cliff into a black hole.
In a lemonade stand, yes, that's how it works. But IREN is dealing with massive financial complexity that has almost nothing to do with their day-to-day operations. So we have to be ruthless here and separate the operating reality, what the business actually did, from the accounting noise.
Okay, so guide me through the noise. Because looking at this profit and loss statement, there are 3 massive charges that seem to be distorting absolutely everything. Where do we start?
We have to start with the 800-pound gorilla. It's a line item for financial instruments, specifically unrealized gain or loss.
Unrealized. My favorite accounting loophole. It just means not real money.
It's not a loophole, it's actually a mark-to-market requirement, but it definitely feels that way. In Q1, the prior quarter, IREN reported a gain of $665 million on these instruments.
$665 million.
Yes. This is likely related to the valuation of their convertible notes or other derivatives they hold. When their stock price moves up or down, the theoretical value of paying back that debt changes.
So let me get this straight. In Q1, they booked $665 million in pure profit without actually selling a single thing or generating any cash.
Correct. Not a dollar of cash came in the door from that. That's why their Q1 net income looks so unbelievably amazing. It was, for lack of a better term, a paper tiger.
A giant paper tiger.
Now look at Q2. That gain completely flipped. It swung to a loss of negative $107.4 million.
Okay, so the swing. The difference between a positive $665 million and a negative $107 million.
It's a $772 million impact on the scorecard, just from that one line item.
That is absolutely wild. A $750 million swing purely based on how accountants value complex financial derivatives on the last day of the quarter.
Precisely. And here is the most crucial part for anyone listening. $0 of that $772 million swing involved cash leaving or entering the company to pay bills. It is purely a valuation adjustment on paper.
So if you're an investor, you have to just draw a line through it, mentally delete it to see the real business.
You have to. You have no choice if you want to understand the actual operations.
Okay, I'm crossing that out with my mental Sharpie. What's the second culprit on this list?
The second one is a mouthful. Debt conversion inducement expense. This was a charge of negative $111.8 million.
That sounds like a bribe. Inducement, like they're persuading someone to do something.
In corporate finance terms, it sort of is a bribe. IREN has convertible debt on its books. They are about to spend billions of dollars on GPUs for this AI build-out, and they want to clean up their balance sheet. They don't want restrictive debt covenants hanging over their heads.
Makes sense. They want flexibility.
So they went to their lenders and said, look, we will pay you an extra premium and inducement if you agree to turn this debt you hold into our company stock right now ahead of schedule.
And that premium cost them $111 million.
It did.
I have to play devil's advocate here for a second. They paid over $100 million just to get debt holders to convert. That seems incredibly expensive. Is that a sign of weakness? Were they desperate to get that debt off the books before something bad happened?
It's a very high price, I agree. And it's a fair question. But I wouldn't call it weakness. I would call it aggressive preparation. If they were truly weak, they couldn't afford to pay that premium in the first place.
That's a good point.
They are choosing to take a massive one-time hit to their earnings today to ensure they have what they see as a fortress balance sheet for the AI build-out tomorrow. It crushes the EPS this quarter, but it lowers their interest payments and their leverage ratios forever.
So it's like paying a huge penalty to break your mortgage early so you can get a better loan for a massive home renovation. It hurts your wallet today, but it frees you up financially for the future project.
That's a perfect analogy. It's short-term pain for long-term strategic gain.
And the third culprit, the third piece of noise.
Asset impairment. A charge of negative $31.8 million. This is the direct accounting cost of the ASIC to GPU transition.
Okay, so the word impairment usually means we made a mistake and we bought some bad stuff that's now worthless.
And that's often true. But in this specific case, it means we are destroying good stuff to make room for even better stuff.
The heart transplant.
The heart transplant itself. They have these mining facilities in British Columbia that are filled with Bitcoin miners, or ASICs. To install the new AI server racks, they have to physically unplug and remove those miners. And since they are retiring those miners before their official useful life is over, accounting rules say you have to write down the remaining value on your books.
So this $31 million is literally the accounting cost of physically tossing the old engine out of the car to make room for the new one.
Yes. It represents the value destruction of the legacy fleet to clear the necessary floor space for the future fleet.
Okay, so if I take the scorecard and I ignore the huge paper losses on derivatives, and I ignore the one-time fee to pay off debt, and I ignore the write-down of old computers, what is actually left?
Yeah.
Is there a real profitable business underneath all of this mess?
That is the million-dollar question, and that brings us to the signal buried in all the noise. And that signal is adjusted EBITDA.
Adjusted EBITDA. I always get nervous with adjusted numbers. It can feel like earnings before all the bad stuff happened.
And you should be skeptical, 100%. Companies absolutely love to hide real recurring costs in their adjustments. But in this specific case, because the distortions we just talked about are so massive and so clearly non-operational, adjusted EBITDA is actually the best proxy we have for the company's real cash flow.
So what's the number? What does the signal say?
The reported standard EBITDA was a loss of nearly $244 million. Looked terrible. The adjusted EBITDA, after pulling out all that noise, was positive $75.3 million.
Okay, that is a night and day difference.
Yes.
So the core operations, the business of mining Bitcoin and selling AI compute, that business actually generated $75 million in profit.
Yes. Now, it's down from the $91 million in adjusted EBITDA they did in the prior quarter, which makes sense given the lower revenue, but it is solidly positive. And here is the single data point that the bulls on the stock are clinging to. Margins.
What about them? Did they get crushed?
The opposite. In Q1, the adjusted EBITDA margin was 38%. In Q2, despite the revenue crashing by 23%, the margin actually expanded to 41%.
Wait, hold on. Explain that. How do you make less money but keep a larger percentage of it as profit? That seems counterintuitive.
It's all about efficiency and the mix of revenue. The Bitcoin revenue is dropping, yes. But the AI revenue, which our source material indicates is a much higher margin business, is growing very fast.
So even though the AI slice of the pie is still small, it's a very rich, very profitable slice.
Extremely rich. So for every dollar of AI revenue they add, they keep much more of it as profit than they do for a dollar of Bitcoin revenue. The overall quality of their revenue stream is improving.
So they're getting smaller, but better.
Yeah.
They're trading raw volume for high-value, high-margin sales.
Precisely. They are swapping low-quality calories for high-quality protein, to torture another metaphor.
That leads us perfectly to the next section. We need to look at these two engines side by side because they are clearly moving in completely opposite directions at different speeds.
The engine room business segment performance.
So we've got a two-speed business here. Or maybe it's more of a two-direction business. One engine is powering down while the other's revving up.
It's completely schizophrenic, financially speaking. You have the legacy foundation, which is the Bitcoin mining operation, and then you have the growth vector, the AI cloud services.
Let's look at the cash cow first, the legacy business. Bitcoin mining. What did that bring in?
Revenue for Bitcoin mining came in at $167.4 million. So, it is still the dominant force here. It's accounting for about 90% of the total revenue for the quarter.
Still paying the bills.
It's still paying the bills, but it's down 28.2% from the $233 million it did in the prior quarter. It's a steep decline.
Is that drop just because the price of Bitcoin fluctuated or because mining got harder? Or is this the heart transplant in action? Is this strategic?
It's the transplant. The analysis is pretty clear that this should be viewed as a managed decline. They are intentionally cannibalizing their own revenue stream.
That is a terrifying strategy for a CEO to have to pitch to their board. You are voluntarily turning off the machine that pays your salary today on the hope that the new machine you're building will actually work tomorrow.
It requires immense conviction. There's no hedging your bets here. Most companies in this position would try to do both, or transition much more slowly over several years. IREN is moving very aggressively.
They're ripping the Band-Aid off.
They are. They are making a very explicit bet. They're betting that a megawatt of power used for AI inference or training is worth 5x, 10x, maybe even 20x what that same megawatt is worth just mining Bitcoin.
And is the market validating that bet? Let's look at the other engine, the AI segment.
Segment 2, AI cloud services. The revenue here was $17.3 million.
Okay, I have to be the cynic again. $17 million. They are a nearly $200 million quarter company. AI is less than 10% of the business. I mean, it's a rounding error at this point. Why is everyone on Wall Street so excited about this?
It's a fair point. In absolute terms, it's small. But in this game, it's all about the velocity. It's about the rate of change. You have to look at the trend line.
Okay, so where was it last quarter?
Last quarter, AI revenue was just $7.3 million. This quarter, it's $17.3 million. That is up 137% in 3 months.
Okay, doubling, well, more than doubling your revenue quarter over quarter is extremely impressive. That kind of growth gets attention.
It does. And remember that huge 20% overall revenue miss we talked about at the beginning? It's highly likely that this $17.3 million number was supposed to be $30 million or even $40 million in the original plan. So even with significant delays, they still more than doubled the business.
So the growth is there, the demand is clearly there, even if the execution of the rollout is a little bit lumpy.
And this is where the whole investment thesis hinges on multiple expansion. This is the holy grail for investors.
Let's explain that.
Right. So Bitcoin miners, because the underlying asset is so volatile, they trade at very low valuation multiples, maybe 10 times earnings on a good day. But AI cloud providers, infrastructure as a service companies, they trade at 30x, 40x, even 50x earnings because the revenue is seen as sticky, high growth, and recurring.
So IREN's goal isn't just to make more money. It's to fundamentally change how the market values the money they make. They want to be treated like a premium technology stock, not a volatile crypto stock.
Exactly. They want to shed the miner skin and emerge from this chrysalis as an AI infrastructure play. But right now, in this quarter's report, they just look like a mutant. Part miner, part AI, with incredibly messy financials tying it all together.
And speaking of messy financials, building all this stuff isn't cheap. We need to talk about the bank account and how they're paying for this transition.
Financial strength and shareholder rewards.
We hear the term capital intensity thrown around a lot in tech circles. In plain English, it just means burning a ton of money to build really big, expensive things.
And AI is, without a doubt, the most capital-intensive industry on Earth right now. You're not just buying a software license. You're buying thousands of NVIDIA H100s and H200s that cost $30,000 to $40,000 a pop.
Just for one chip.
For one chip. You are building data centers with incredibly complex liquid cooling systems. You need a fortress balance sheet, as they say, to even play in this game.
So does IREN have a fortress? Or are they living in a straw house that's about to get blown over?
According to the report, they are flush with liquidity. They have hundreds of millions in cash and ready access to capital markets. So the short answer is they can afford the chips. They aren't going bankrupt tomorrow.
I sense a but coming. There's always a cost.
The but is dilution. It's the cost of capital. We talked about that $111 million debt inducement charge. How did they pay that? They issued new shares. How are they paying for these new GPUs? They are raising cash by issuing new shares.
So as an existing shareholder, my personal slice of the pizza is getting smaller and smaller every quarter.
It's getting smaller rapidly. This is the explicit cost of participating in this land grab, as management calls it. The company is effectively saying to you, the shareholder, yes, you own a smaller percentage of the company today than you did yesterday. But to T, the company itself is going to be 100 times bigger in the future, so your tiny slice will still be worth a fortune.
It's the classic startup pitch. It's the Facebook movie. Do you want 10% of a grape or 1% of a watermelon?
Exactly. But right now, shareholders are feeling the pain of that shrinking percentage, and they haven't seen the watermelon yet. They just see a smaller slice of a business that just posted a $155 million loss. It's a tough pill to swallow.
And we also saw that asset impairment charge again on the balance sheet. I want to circle back to that because it connects to their financial strength. They wrote down $31.8 million in assets. Doesn't that hurt the balance sheet and make them look weaker?
It does reduce the book value of their assets, yes. But it's also a sign of what economists call creative destruction. Management is showing they're willing to take the hit. Many weaker management teams would keep those old, obsolete miners on the books at full value just to make their asset column look inflated.
Right, they'd pretend the old engine is still worth what they paid for it.
IREN is taking the medicine. They are cleaning the house, even though it makes the balance sheet look a little smaller in the short term. It's a sign of financial discipline in a strange way.
It sounds like they are burning the ships. There is no going back to just being a miner. They have cleared the floor space, they have paid off the debt at great expense, they have taken the accounting hits. They are all in on this AI pivot.
They are fully committed. There is no hedge here. They either cross the valley or they don't.
So who are the generals leading this charge?
Yeah.
And what are they telling the troops, the investors, about the road ahead?
The road ahead management's outlook and key takeaways.
The company is led by the co-founders Daniel and Will Roberts. I've followed them for a while. They aren't exactly what you'd call timid.
No, they are aggressive. And their entire philosophy right now can be defined by one phrase they use constantly: land grab.
Okay, unpack that. What land are they grabbing? Are they buying up real estate?
No, not land. Power. They believe we are in a world where NVIDIA can print chips faster than utility companies can build power plants and transmission lines. The true bottleneck for the entire AI revolution is no longer silicon. It is electrons. Access to cheap, reliable power.
So their core argument to investors is, we have the grid connection. We have access to 1.4 gigawatts or whatever the number is today. That is the truly scarce resource in the 21st century.
Exactly. You can call up Dell and order servers. You can call a contractor and build a shed. You cannot easily call up your utility and get a new grid connection for 500 megawatts in 2026. The queues for that are 5, 7, even 10 years long in some places.
But IREN secured this power years ago for the purpose of mining Bitcoin.
Right. And now that power contract that they signed is a golden ticket. It's an almost insurmountable competitive advantage.
It's like they bought a giant empty parking lot in the middle of Manhattan in the 1980s for cheap, and now everyone suddenly realizes they need to build skyscrapers there. The value of the underlying land just exploded.
That is the perfect analogy. And management isn't selling the land. They're saying, we're going to build the skyscraper ourselves.
So let's synthesize this whole idea of the Valley of Transition. We have the legacy revenue from Bitcoin, which is volatile and shrinking. We have the future revenue from AI, which is exploding but still very small. And in the middle, we have massive expenses from impairments and debt conversion and shareholders getting diluted to pay for it all.
It is the most dangerous, precarious time for a company like this. If they run out of momentum here, or if the demand for AI training suddenly cools off for some reason, they are stuck in the middle of that valley with empty data centers and no Bitcoin miners to fall back on.
But if they make it across the valley?
If they cross the valley, they emerge on the other side as a Tier 1 AI cloud provider with massive recurring revenue margins valued at 30 or 40 times earnings. The upside is asymmetrical to the downside.
So, for the listener at home, trying to make sense of this very messy quarter, was the big miss a sign of a fundamental failure of execution, or was it just the unavoidable cost of doing business during a massive renovation?
The source material, and I think I agree, leans towards it being the cost of construction. That 20% revenue miss is concerning. It shows that they aren't perfect at predicting their own timelines and they need to improve that. But the structural pieces, the access to power, the cash on the balance sheet, the margin expansion in the new business, those are the real signals to watch. The foundation seems to be intact.
It's like we said at the start. The renovation is late, it's over budget, and the neighbors are definitely complaining about the noise. But the house is still standing, and the blueprints for what it's going to become look absolutely incredible.
And maybe most importantly, the new tenant, Microsoft, is still waiting with their checkbook to move in. That's the key. Outro.
So we arrived at the end of our deep dive, and I want to leave you with this thought.
Yeah.
We often look at these quarterly earnings reports as, a report card on the past 3 months. We obsess over the miss or the beat.
Right. It's very short-term focused.
But sometimes an earnings report isn't a report card on the past. Sometimes it's a map of the next 3 years.
That's a great way to put it. You have to look through the windshield, not just the rearview mirror.
The market looked at IREN's report, and it saw a 20% miss and a huge net loss. Yeah. It saw a messy construction site, and it punished the stock. But here is the debate I want you to have with yourself. Is the market punishing IREN for the temporary messiness of the construction site? And in doing so, is it ignoring the skyscraper they are building?
Or is the alternative true?
Or is that 20% revenue miss a legitimate warning sign that the foundation is actually cracking before the building is even done?
And that is the multi-billion-dollar question, isn't it? If the AI revenue accelerates next quarter to $40 or $50 million, this dip will look like a massive missed opportunity in hindsight. But if the miss happens again, the narrative could change very quickly from transition to incompetence.
It's high-stakes poker with gigawatt data centers. I love it.
It's the most interesting sector in the market right now, by far.
Just a reminder to everyone, none of this is financial advice. We are just two voices breaking down the data that's in front of us. Please do your own research. And full disclosure, this content was generated by AI.
Always double-check the numbers for yourself.
And speaking of checking the numbers,
want institutional-grade stock research without the institutional price tag? Check out STOCKANALYTICS.AI.
For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they get the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at STOCKANALYTICS.AI. Make smarter investment decisions with research you can trust.